tax asset and valuation account. At the end of 2019, its first year of operations, BD Company reported taxable income of $38,000 and pre-tax financial income of $34,400. The difference is due to the way that the company handles its warranty costs. For tax purposes, BD deducts the warranty costs as they're paid. For financial reporting purposes, BD provides the year-end estimated warranty liability based on future expected costs. BD is subject to a 30% tax rate for 2019, and no change in the tax rate has been enacted for future years. Based on verifiable evidence, the company decides it should establish a valuation allowance of 60% of its ending deferred tax asset. Prepare BD's income tax journal entry at the end of 2019, and then prepare the lower portion of BD's 2019 income statement. So let's first look at this deferred tax asset, which would be the difference between the $38,000 and our $34,400. For the deferred difference of $36,000, and that's really not, I shouldn't say the deferred difference, that's the warranty cost difference. And then the deferred tax asset is that $3,600 times the 30% tax rate. So $1,080 will be our deferred tax asset. As far as our income tax payable, it's going to be equal to our $38,000 of taxable income times that 30% tax rate, and then our income tax expense is going to be equal to that tax payable plus the $1,080 deferred tax asset, sorry, not plus, minus, because it's an asset, for $10,320. So now that we have those numbers, we can do our journal entries. December 31st, income tax expense, the $10,320, deferred tax asset, we calculated as $1,080, and then our income tax payable for $11,400. And then, because of this valuation allowance, we need an additional journal entry on December 31st for income tax expense and allowance to reduce our deferred tax asset to realizable value. That one's a mouthful. And so this is going to be equal to our $1,080 times this 60% valuation allowance of $648. I'm going to change this so that we can see it. Okay, so we have our journal entries done, and then we also need to prepare the lower portion of the income statement. So I'm just going to put part 2 here, and I'm going to just skip the title portions of the income statement and just get straight to the account. So we'd have income before income taxes, then our income tax expense, and then net income. And income before income tax was $34,400, because remember, this is our financial statement, so we're using the financial income that would be reported. Our income tax expense is going to be equal to our $10,320 plus the $648 for $10,968, and then we subtract that expense out of the income for net income of $23,432.